work for me. All right. So I want to start off with a lot of people have been texting me, calling me, asking me what's going on, right? And what's the state of the economy? There was all this talk about a bad economy, and now people voted for Trump to fix the economy, and people aren't seeing a better personal economy, and they want to know really what is happening. What is the economy? What's happening? How is it impacting everyone? So if we look at 2024, when people thought there was a bad economy, the economy actually grew 2.7%, and it's worth $30.34 trillion. So, you know, that the perception of a bad economy really reflects people's personal economy, meaning if they weren't doing well personally, they attributed it to the bigger picture. And what we saw was that there are two Americas now, right? So we saw the rich get richer and the poor get poorer at the same time. And so the income divide became greater, and those who were moving in the wrong direction perceived it to be a bad economy, and those who were moving in the right direction saw it as a great economy. If we look at the number of billionaires in America, there are 756 billionaires in America, but that 756 billionaires holds $5 trillion worth of wealth. So if we have a $30.34 trillion economy, they're holding $5 trillion of it themselves. Um, there are a lot of millionaires in America. There are 24.5 million. Listen to that. There are 24.5, right? That's 24,500,000 millionaires in America. Unfortunately, while Black people make up 14% of the population, we're only 8% of the millionaires. Um, I told you the wealth gap increased significantly in 2024. So the top 10% of earners own 67% of the country's wealth, and the bottom half of earners only own 2.5%. So again, we see this income gap getting greater and greater, where the rich are getting richer and the poor are getting poorer. When we look at Black families, they have $1 million on average less wealth than white families. When we look at Hispanic families, it's even worse, $1.1 million less wealth than the average white family. And we're seeing a big number of people living in poverty. So when you define poverty as living at or below 26,500 for a family of four, we're looking at 11.5% of the total population, but 17% of the Black population, which is, astronomical. That's more than a third of the Black population is living in poverty. So when we see this big wealth gap, where we see the disparity in the total population, but even worse disparity amongst Black people, it makes people really fearful, but it also gives the misperception that there's a bad economy. And so what we have to figure out today is, if people are getting rich in this economy, why are we getting poorer in the same economy? It's because we don't have the right plan. We've been following a plan and a strategy that's taking us in the wrong direction. So how bad is it really? It gets even worse. Of the total population, nearly 70% of adults don't have $1,000 in savings. So if an emergency came up, they would have to sell something, or they have to try to use credit for an emergency because they don't even have $1,000 saved. And 27% of adults have no savings at all. So we're not even talking about less than 1,000. We're talking about zero. 32% of Gen Z, and there's a new generation Beta just got started in January. So we have pretty much boomers, X, millennials, Z, alpha and beta. Like, we got a lot of generations happening right now. But Gen Z has less than $1,000. 32% have less than 1,000 in savings. Millennials, 31% have less. Gen X, which is my generation, 27%, and baby boomers, 20%. So baby boomers came up in that time when they were told, put some money away for a rainy day, right? But the problem is they save in the wrong vehicles and they didn't invest. And we're going to talk about the difference between saving and investing, because saving actually costs you money when investing actually allows your money to grow. The median net worth of the average U.S. household, and median means right down the middle, doesn't mean average, right? Median household, 97,300. The average is significantly less, which is 76,200. And that number is pushed up because of the amount of big earners who have extraordinary incomes. Um, and then under 35, the median net worth. Now, people don't really understand net worth, so let me just make this clear. Your wealth is not dictated by your income. Your wealth is dictated by your net worth. So what is net worth? Net worth is the value of your assets minus the value of your liability. So what does that mean? The value of the assets. So certain assets are personal property, real property, could be cash, could be collectibles, could be your stocks, securities, all these things. The value of all those things minus your debts on the other side. And the net total of that is what your net worth is. And when we look at net worth, it's frightening, right? When we look at the net worth of people under 35, we're talking about $11,000. And part of that is because a lot of millennials and younger have not been able to buy houses, and homes are usually where you get the largest amount of your net worth. So what's even more scary is 14% of Americans, which is 16 million, have a negative net worth, meaning they owe more than the value of whatever assets that they hold. So they're actually moving backwards. And we understand that time is the amplifier of all things. So when I say the rich get rich and the poor get poorer, if you continue doing what you're doing, you'll get more of the same. So if you're going backwards, you'll go backwards probably faster and more efficiently backwards than you've been going. And the same goes for when you are moving in the right direction. So, having this information for a lot of people is really scary. And what you take away from that information really will dictate what you do next. And a lot of people see that information and say, wow, if there's a tale of two Americas, then only certain Americans have access to wealth where everybody else is suffering. And that's not the case. The reality is, yes, there are two Americas, and we do see the wealth gap widening, but there's a difference between lack of access and lack of knowledge. And it is not a zero-sum game where the people on that side are doing anything to suppress you from getting there, because they cannot stop you from getting some of that unless they stop themselves, because all they're doing is following the rules. What people don't realize is there are different rules based on the avenue you choose to go down to get income and wealth. And if you choose a certain path, which most people do, because that's where we're steered and groomed to go down by our parents, by schools, by media, by institutions, we're all groomed to go down a certain path, and we don't understand the other path. We think we don't have access. But there's nothing to stop you from getting access and going down the exact same path except knowledge, right? And so I'm going to share some of those things with you today so that you have a choice. You can still remain down the path you're going if that makes you happy, but you'll at least have an alternative if you want to do something different. So I keep getting these other questions. Well, I get all that, but should we be worried? The president is threatening tariffs. And if we have tariffs, what does that mean? That means we have trade wars. We have trade wars, we're going to get increased costs, right? We're going to get inflation, and we're going to have the stock market's going to drop. So my 401k will do bad. And the president's dismantling the Consumer Protection Agency. That means banks are going to give bad loans. And what does that mean? And interest rates are still high. And that means I can't buy property. And the inflation rate is creeping up. Right now it's 3%, and it was 2.89% in December and only 2.75%. So inflation's going the wrong way. And they're talking about cutting Social Security because in 2035 it's going to be bankrupt. And so if you look at these small things in the grand scheme of things, you will panic and think you have nowhere to go. And the reality is, yes, those things will happen. But what I want to share with you today is that despite those things, there's opportunity, right? If If inflation occurs, there's opportunity. If interest rates go up, there's opportunity. If the banks don't have protections and they're starting to lend much more freely, there's opportunity. If Social Security changes, there's opportunity. And if you understand where the opportunity lies, you don't worry about those things. And again, having a very strong blueprint that allows you to navigate in every economy, no matter who the administration is, no matter what the social trends, no matter what the political trends, no matter what the ideological trends, no matter what's happening, if you have this blueprint that the wealthy have, because they did what? They did well during COVID when everybody else suffered. They did well when we had this inflationary pressure when everybody else suffered. They did well with high interest rates when everybody else suffered. They did so, and I'm telling you that you can do well in these things too. You just can't follow the same path that you've been following. So let's just get to it. I'm not even going to waste a whole lot of time. I'm going to get to it, and I'm going to show you exactly how to use that plan. So you have to again, you have to make a choice, right? And you have to be willing to let go of what's comfortable. You have to be able to let go of what's familiar. You have to be able to not be rigid, because as you know, as we age, we get cemented into the way we think. But you have to let go of that and learn to be flexible and responsive to everything that's happening. So you want to kind of sway and go along with what's happening as opposed to being trying to be rigid. So let's get to it. Here's the blueprint, right? And I say become anti-fragile. So what is anti-fragile? So there's a guy named Nicholas Nassim Taleb who coined the term anti-fragile. And people say, well, what the heck is anti-fragile? Well, let's just talk about the other end of that. Most people are fragile. And that's why they worry about the things that we talked about earlier. If you don't have savings, you're fragile, because any impactful, unpredictable, as I like to call it, that comes up, and it will come up, whether it's a medical thing and you don't have enough for the deductible, or you don't have insurance, whether it's the car breaking down, whether it's the children need something, whatever it is, if you don't have certain things in place, the slightest thing breaks you. That means you're fragile. If the economy dips, you're fragile. If you lose your job, you're fragile. All these things. So we know what makes us fragile. And most people are fragile because the slightest hiccup will totally throw the game off. So what's the opposite of being fragile? Most people think the opposite of being fragile is being robust, right? Resilient. I want to be resilient against these things. No, I don't want to be resilient. Anti-fragile is the total opposite. And when we say anti-fragile, it means that stressors actually make the system stronger. And we can think of it like building your muscles. You have to stress your muscles for your muscles to adapt and grow. And when you have a blueprint that makes sense, those same stressors, the economic stressors, political stressors, social stressors, actually make your system stronger and allow you to benefit no matter what is going on. So you don't want to be resilient against it and just hold on to what you have. You want to be anti-fragile and profit from every cycle and every trend that happens. And the blueprint we're going to talk about will allow you to become anti-fragile. So it starts, though, with really having a recognition of how you want to live, not only now, but in the future. And let me just make some sense of that. And I have separate slides for these. Most people settle for whatever life they can afford, but still want more, so end up overextending themselves, trying to live a lifestyle they can't afford. And I'm saying that happened because you started backwards. You looked for your stream of income first, and then tried to build a life on the income that you got, instead of really thinking about and designing the lifestyle you wanted, and then finding the income that would fund it now and in the future. So the first part of it has to start with you having a real vision of what you want. Then you have to develop multiple streams of income to fund your designed lifestyle. Then you have to create an emergency fund. then you have to eliminate high interest debt. Then you have to build a very diverse investment portfolio. Then you have to use the best tools to protect what you've built. And then what's really important so that it doesn't just all go to waste, you have to develop a plan to seamlessly pass on your wealth. So let's get to how we pull that off and what that looks like. So when we talk about design the lifestyle you want, you have to be able to really assess where you are without judgment, right? It doesn't matter how you got where you are or why you got in the position that you're in. You're there. And if where you are isn't exactly where you want to be, it's okay, right? It's okay to say, I want something different than what I have. It's not being ungrateful. And I'm not saying don't have gratitude for where you are. You should have gratitude for where you are, but it doesn't mean you should be content, because there's a difference between having gratitude and being content. You can have gratitude and not be content with your situation and want something different for yourself. And it's okay to put that on paper. And depending on your age, you should also consider where you want to be down the road, right? So if your children are young or you don't have children, if you don't have children, do you plan to have a family? If you have a family already, one day you'll be an empty nester. What will that look like? One day you'll be, older and retired. What does that look like? You should have a clear vision. And of course, you have to update this periodically, but you should have a clear vision for what you want, because instead of living paycheck to paycheck, you're living in the future and planning and getting income today for tomorrow. And that's a big difference. And you won't waste time on things that don't fund your vision for your lifestyle now and in the future. So you have to put a dollar figure to it. And that's the real challenging part. People don't want to take that time. I want to live in this neighborhood. What does it cost to live in that neighborhood? Do you want to rent? Do you want to own? What does it cost to rent there? What does it cost to own there? These are the types of foods I want to eat. I want to have this particular diet. Well, what does it cost to have that particular diet? These are the places I like to visit. Well, what does it cost to visit? These are the clubs I want to be in. What does it cost? Just put a dollar amount to it and be real with yourself. And it's okay. And being realistic with a real time horizon, right? Because depending on where you're starting, you can't have all that tomorrow. And you set yourself up for failure when you say, I have people who I know are deep in debt and they come to me, I want to be a millionaire by next year. Okay, well, we didn't even get you out of the hole. And you're talking about being a millionaire by next year. Not to say it's totally impossible, but the more aggressive your timeline, the more resources, the more time, the more energy, the more capital, the more everything, that more risk that it's going to take to try to get there. And most people aren't willing to do that. So let's get a realistic time horizon that's achievable for the lifestyle you want to live also. And unfortunately, humans are horrible forecasters of time. So you probably will need a little guidance in terms of how realistic it is to get to where you want to be. Don't focus only on material things. And I think it's easy in the beginning, because when you feel like you're lacking, it's like, well, I want this, I want this, I want this. But that wears off. I promise you, the material thing will wear off really quickly once you start having the ability to get material things. That will wear off really fast. And then it will be more about the experiences and the lifestyle itself. So just keep that in mind. You need to create multiple streams of income in order to fund the lifestyle. Now, I think most people hear the word income and don't realize what income is. Most of us haven't been taught that word. We've said, go get a job so you can get paid. Go get a job so you can get money, right? We don't understand that income, what income is. Income is the money that comes in from all sources, as opposed to the opposite of that, which is expenses, which the money that goes out for all expenses or all costs and debts. So it's just one side of a balance sheet. It's income. And there are several different types of income. And most people don't realize that. So we have earned income, we have profit income, we have capital gains, we have business income, we have interest income, we have dividend income, we have rental income, and we have royalty income. The three that are in red on the slides are what we call active income, because you have to do something actively to get it. And the others in white are what we call passive income. Now, why is that important? Most people derive their income primarily from active income streams. When we say earned income, what does that mean? A job. Any W-2 wage earner, any independent contractor, any self-employed person, any um, tip person who works for tips, that's all earned income. That's active earned income, meaning your person, your body, you yourself has to do something. You're exchanging talent, or you're exchanging time, or you're exchanging your capabilities for money. Um, Again, most people have learned and mastered that part. The problem is, as we age and the world changes, we lose our ability or our desire to continue profiting from earned income. And there has to be this transition at some point where your passive income overtakes the earned income so you can sit back and enjoy life strictly from passive income. But let's get to the earned income. Like I said, is that what is profit income? When you go to the fair and you set up a table and you sell things from the table, it's things that you bought for one price and you sell for another. Things that you crafts, things that you made and you sell for a profit. That's profit income. And it gets taxed exactly the same way as earned income. And that's important because the active income streams get taxed higher than the passive income streams. Different world. Capital gains. What are capital gains? People come to me all the time. I want to learn how to trade stocks. When you trade stocks, that's capital gains income. Again, you buy it for one price, you sell it for another price. You pay a very high tax on capital gains, short-term capital gains tax. People would come to me and say, I want to flip houses. Okay, that's capital gains. Again, you buy a property for one price, you sell it for a higher price. The taxes on that are enormous. The issue with earned income, profit income, capital gains is this: none of it is residual either. It's a one-shot deal. I get a job, I work hours, or I work on a project, they pay me. Profit income, I sell this thing, they pay me. Same thing with capital gains. I flip this property or I sell this stock, I don't own it anymore. It's a one-shot deal. That means you have to keep doing that over and over and over and over to get income. That's not very efficient to have to do that. And it makes you fragile because when the economy shifts, a lot of those things in the earned income category or the active income category uh, don't allow you to get income, right? So when we start thinking of the others, and people say, what's the difference between business income and profit income? Business income is a business that you have an ownership interest in, where others primarily do the work and you get paid from it, right? So it's not your personal labor that creates the income, it's the labor of others, and you have an ownership interest in it, and they pay you. And then we have interest income. So what's interest income? I think I got a slide for this actually. Do I? I think I do. No, maybe I don't. So let me just go through it. So interest income is when you lend money for a fixed amount of interest. And people say, well, what's that? When you put money in the bank, you lend the bank your money, and that's why they give you interest. They're actually investing your money. But most people put it in a traditional savings account. And a traditional savings account is where you're going to lose money. Write this down, if you go on bankrate.com or if you go on nerdwallet.com, you should look for a high interest savings account. High interest savings are generally not linked to brick and mortar banks. That's why they can offer you more. They are online banks. So you have to have probably a brick and mortar account to funnel your money into. But some of them also allow you to have debit cards and to use ATM machines without a fee. So you should go on NerdWallet or bankrate.com and get a high interest savings account. The interest rate right now is probably 4.5% for a high interest savings account, as opposed to a regular savings account. Also, money market accounts are probably around 5% right now, which are very similar to high interest savings account. CDs right now are doing well. They're in the 4 to 5% range. Also, the difference with a CD is though that it's you have to lock in for a year. There's a term. Sometimes it's a year, sometimes it's 2 years. It's as low as 6 months, but the money is locked in there for the return. Um, there are certain bonds that do well when interest income is high. There are crowdfunding tends to pay well when interest income is high. So when we talk about, oh, interest rates are high, is it bad if you want to borrow money? Yes, but it's great if you want to lend money. And when you put yourself on the right side of this equation and you become the lender, the loan becomes an asset to you. When you become the borrower, it's a liability to you. So we want to put ourselves again on the right side of the equation. And then we have what we call dividend income. So dividends are a distribution of the profits that a company pays to its shareholders quarterly. So a lot of people buy stocks without having a vision. So for me, I want things that are going to pay me. I'd say 90% of my stock portfolio pays me dividends every quarter. And why is that important? So again, if my goal is to transition completely to passive income, I want my stock portfolio not only to grow in value, meaning I have to sell it to get capital gains. I want it to grow in value because I'm going to pass that on to another generation. But I want it to pay me quarterly at the same time. So I only look for stocks that will pay me dividends. So I will leave other stuff that people get excited about on the table because there's no way for me to extract the money from that unless I sell it, and I don't want to sell it. And then we have rental income. So most people, when you think of rental income, only think of I have to buy a property, a piece of real estate, and get rent from it. That is a fantastic way to get rental income. But you can rent and sublet and get rental income. You can now they have sites where you can rent your camera equipment, you can rent tools, you can rent your bicycle, you can rent your car, you can rent pretty much anything that you own. There is a website for it that you can rent these things and get rental income. So as many things as you want to start getting rental income from also. And then we have royalty income. So what's royalty income? Royalty income is income that's derived from intellectual property. So if you write something, a book, if you write a song, if you create a video, you can get royalty income from it. And today, there's no reason why any and everybody can't because of AI. If you have an idea and you dump it into artificial intelligence, it will spit out something that sounds just like you wrote it. It'll be in your voice if you program it properly, but it will get the job done in a matter of minutes to hours, what would have taken you months to years. So everybody has an opportunity at some point to do some royalty income as well. So how much income do you need? That goes back to, again, designing the lifestyle you want to live now and the lifestyle you want to live in the future. So you'll need a sufficient amount of income. And if you're at a place where you're not getting sufficient income, you need to change that or you need to add to that. So you need sufficient amount of income, not only to fund how you live today, but also to be able to acquire assets that will get you these returns and grow with compounded growth in the future. So, like I said, most people get their stuff from earned income, but you want to start moving away from that and moving towards the passive income streams. You want to have passive income streams or even just multiple income streams that are what we call uncoupled. Now, what does that mean? So I had a client and he was excited because he said he has multiple streams of income. And I said, well, okay, well, tell me about these multiple streams of income. So he has a job in IT, right? So information technology. So he troubleshoots computers for this company. And he said, when I started my own business on the side, I said, well, what's the business you started on the side? He said, I did an IT business, but not for companies, but for regular people. I go around and troubleshoot computers for regular people. And he said, I started my investment portfolio. I said, well, what are you investing in? Well, just IT companies because that's what I'm familiar with. And I said, well, if something happens where technology, there's a major shift in technology, you're in trouble. And certain times during the economic phase when people don't have the money to buy new equipment or to pay for things to get fixed, you're in trouble because all those things are what we call coupled. So if one goes down, they all go down. So what we want is to uncouple those things by diversifying, right? So if you work in IT, don't buy stock in that company. Don't buy IT stock. Buy something that is almost opposite of that. And the same thing, if you start a business, don't start a business in that because if that goes down, it's all going down. So we want to have these things that are unrelated so that as we have, again, social trend shifts, technological shifts, when we have all these shifts, you don't lose everything at one time. Let me see. So you have to understand that unlike active income, which you can get a lot of it fast, um, passive income is something that grows over time. So the thing is to start immediately. So you have to have what we call time in and stop trying to deal with timing, right? People say, when I get some more money, I'm going to. No, do it now and let it grow because it grows different. It grows exponentially, not linearly. Um, so that's important. And most passive income streams, when you're talking about uh, say index fund, you can start with $25. A lot of the peer lending, you can start with $100, $25, $200. Interest income, same thing. All these different areas, you don't need a lot of money to start, but you have to get started, and that's important. So you got to talk about creating an emergency fund, and I'm going to probably mess some of your heads up when I say an emergency fund because most of us have been told. Well, let me see. I'm going to open up the mic for a second. What is usually the recommendation when somebody says for how much you should have for an emergency fund? Does anybody have?
$1,000.
So some people say $1,000. I've heard that.
Six
And
months of
6 months,
your income.
6 months of your income. I've heard 6 months before. I've heard 3 months before, right? So people say 6 months of your income, 3 months of your income, $1,000, right? So we're going to throw all that out the window because that's lazy. That's lazy. And that doesn't tell you, and not only is it lazy, 6 months worth of your income is a waste of your money. So let's talk about this. First of all, you have to identify what an emergency is. We have to identify what an emergency is. So every emergency, right, or every expense doesn't require it to be covered in an emergency. So some people say, what's an emergency if I lost my job? So I need 3 months worth of income or 6 months worth of income. Why would you need 3 to 6 months worth of income? What do you have? What has to be paid? If you have a mortgage has to be paid. So you have to have enough to cover that for maybe 3, 6 months, depending on how comfortable you are. What else is an emergency? You have life insurance. You don't want to lose that because a gap in the life insurance. So you got to pay your premium for your life insurance. What about your deductible for your health insurance? If you know you have a cap on the deductible, you need to have that amount. Whatever deductible amount, the highest deductible on all your insurances, that amount you need to have. What's probably if you drive and you have to have your car, what's the highest expense for repair? Maybe transmission. If the engine goes, it's thrown in the garbage. So maybe you have to see how much the transmission, 2,500, maybe 3,000. What else has to be paid? Well, if you've ever had an emergency, you can go 3 to 6 months without paying your utility bills and they're not going to shut it off. You can go 3 to 6 months without the cable bill because you don't need cable. You can go 3 to 6 months without a whole lot of stuff. You need food, right? So you have to really decide what an emergency is and have that amount. And it's going to be a little bit different for everyone because if it's just you, it's a little different than if you have a family of five, right? But you have to really take time to step back and say, okay, in an emergency, if it's a one-time thing like your car or a medical expense or something like that, what's the maximum amount I'm going to have to pay for that? if it's and all you don't have to have it covered for all these things because what's the chance of you having a medical emergency and transmission going out and you lose your job all at the same time? Like that's just it's not realistic. So it doesn't even mean you have to have it for all of these things. But what's the highest of those things, right? And again, if it's the losing your job, what expenses have to be covered for that? And how long is it going to take you to get another job, right? If it takes you 6 months, you're probably unemployable. So you have to consider that, and you probably should shift to some passive streams of income anyway. It shouldn't take you 6 months to get a job in an economy where there are lots of jobs. So once you decide what an emergency is and what the expenses are, and you determine how much you need for your emergency fund, it might be more than $1,000, probably more than $1,000, but it's far less than 3 to 6 months of your income, and it's far less than 3 to 6 months of your total expenses. Um, so whatever you think, you can double that, right? So if you say my highest expense would be if the transmission blew, that's $3,500, then I'll double that, then it's 7,000, right? Or the highest expense would be covering my mortgage, food, whatever for 3 months, then I would double that amount, right? Um, Other potential emergencies, that's why you have insurance, right? So if it's a car accident, then your insurance should cover that, but you just have to be responsible for the deductible. And the same with health, right? Healthcare, you should have healthcare coverage. If you don't have healthcare coverage, you are fragile because you never know when something's going to happen. You can get sick or injured. But what's your deductible, right? So those are the things that you should have to consider. And where should you put that money? Again, high interest savings account because it is easily accessible. You can have your money, wired to you next day if you need, or like I said, some have, bank cards. You can get that money immediately if you need it. So, but that's designated just for that, right? And so there's not much more you need in your savings except that, or if you're looking at long-term savings for your lifestyle down the road. And what am I talking about? Every major appliance in your house, every major purchase that you have has a lifespan, right? So if you have a boiler, it has a lifespan. If you have a hot water tank, it has a lifespan. If you have a car, it has a lifespan. If you have a refrigerator, it has a lifespan. You should be considering the lifespan of those things and what the cost is, and then put a little bit away, a little bit away, a little bit away, leading up to that time where you have to make that major purchase so that you don't. And that's what we do, right? We don't plan for that. And then we get hit with a major purchase. We don't have the money. And then we end up using the credit card. And then you have this big debt. And then you're going backwards again. So not only your emergency fund, your major purchase fund, you should consider also. After you have your emergency fund, and this is prioritized, and this is the order, you have to eliminate high interest debt. Now, all debt is not bad debt. There's good debt, which we call leverage, and there's bad debt, which are liabilities. So I'm not talking about the good debt. Let me just talk about good debt. Good debt is what is going to accelerate your ability to buy assets that are of great value. And what most people don't get, it makes more sense to borrow for assets, certain types of assets. And I'll give you an example. If I wanted let's say I wanted to buy $1 million rental property, and I wanted to save $1 million, it's going to take me a long time to save $1 million. And let's just say the building paid me $100,000 a year in rent. So if I paid $1 million and I got $100,000 in rent, then I make a 10% return on my money, but my 100,000 is locked up in that building, right? Because that's how assets work. You don't lose the money; your money just transfers into the asset. So your 100,000 is in the building. You can extract it by selling it. You can extract it by borrowing against it, but your 100,000 is stuck in the building, and you're making 10% on the money. That's a good return on investment. But let's say I borrow the money, right, with a mortgage. So now I'm using what we call leverage, and I want $1 million building, and I can put 4% down and 6% closing. Now I only have to save $100,000, which I can probably do a lot faster than saving $1 million. Now for the same $100,000, I have $1 million building that pays 100,000 a year, but that 100,000, I don't get to keep all of it. Let's say 60,000 of it goes to pay the mortgage. 60,000 goes to pay the mortgage. Um, Now we're talking about $40,000 a year on $100,000. That's a 40% return on investment. That's a much better return on investment because my return is on the money I have tied up in the building. So now I have a 40% return on investment as opposed to a 10% return on investment. It only cost me $10,000 and the debt's being covered by the rest of the rent. So that's what we call good debt. So you have to have the right relationship with debt. And most people don't have the right relationship with debt. You shouldn't be borrowing money that's not covered by what you borrowed the money for. So if we borrow it to buy an asset that produces income, the income should cover the cost of servicing the debt. Bad debt is mostly credit card debt or student loans and all these other debts that are not covered by what we borrowed the money for. And the reason I say, and if you notice, I said eliminate high interest debts before I said anything about investing, is because usually the interest on a debt outweighs the return on an investment. So when we look at credit cards, I believe the highest rate right now is 32%. You can pay 32%, and a lot of people pay in the 20 something, 26, 27% interest on a credit card when historically the S&P 500 did about 11%. It's doing about 23, 24% now. But if you invested in the stock market in the S&P 500, you get 23% as opposed to 32% on your debt. You're going backwards if you do it that way. So you have to eliminate the bad debt first. So there are a couple of ways to eliminate debt. And the two most efficient ways are probably the two most popular ways are the snowball method and the avalanche method. Now, I have a personal preference for the avalanche method, but it's more palatable for some people to do the snowball method. Let me explain that. So snowball method comes from that. If you just think of a cartoon, somebody starts with a tiny little snowball and they keep rolling it and rolling it and rolling it, and it gets bigger and bigger and bigger and bigger and bigger. That's the snowball method, meaning you attack your smallest debts first. So if you only have a fixed amount of money, you might pay the minimum on everything except the smallest one, and you put as much as you can on the small one and knock it out. And then you take all the money you had been putting on the smaller one and put it on the next biggest one, right? What you put before and that. And so now you have more money on that when you knock it out. That one will get knocked out faster than the previous one. When that's knocked out, you take all that money, put it on the next biggest one. And you keep doing that, and you keep having more money to put on each successive debt. That way is more comfortable for people because they can see the progress, right? And it feels good to be able to knock out a debt, small debts. The avalanche method, again, which is the one that I prefer, you analyze which one is hurting me most. And that's the one that I attack first, meaning, and two ways to look at it. Which one has the highest interest rate on it? Because that's the one that's bleeding me the worst. And whether it's the biggest, the smallest, or somewhere in between, because that one is hurting me most, I attack that one first. And when I knock out that high interest one, it still gives me more money to now look for the next one that was hurting me most. And I take all that money and put it on there. And you keep doing that successively based on which one is hurting you most. I think you should also consider which one you have the most to lose from if you default on. Two, right? There are secured debt and unsecured debt. And what does that mean? Secured debt, if you have a car, there's a lien on the car. If you don't pay, they will take the car. If you have a mortgage and you don't pay the mortgage, there's a lien on the property and they will foreclose and take your property. So you can look at it that way too, right? I have to address the things where I have the most to lose because they can take it from me, but also the ones you want to look at are the most that are bleeding you because of the interest. That being said, it doesn't mean you shouldn't eliminate all other liabilities. And when I say all other liabilities, I'm not talking about monetary liabilities. I'm talking about non-performing investments that don't make sense anymore, right? And it might be just the shift in the mindset and say, oh wow, I own this stock in, I don't know, Tesla, and Tesla doesn't pay dividends. Why am I owning Tesla? I can take that money out of there and put it in Coca-Cola. Coca-Cola pays dividends. It makes more sense for the structure of the plan because it provides income, right? And so anything that's not contributing to the success of what you're trying to do is actually a liability. And so you want to examine that. And that means just looking at small things like subscriptions that you don't really need or use anymore that are bleeding you and taking money. And again, it could be a small subscription, $25 a month, but that $25 could have been invested, right? Getting you money as opposed to costing you every single month. And that means really creating a budget and examining where your money is going and where money is just bleeding and not contributing to the lifestyle that you want to live. All those things get cut off. All those people get cut off. All those, that gets cut off. And you take that extra money and then put it somewhere that's going to actually make you money to fund the lifestyle that you want to live. And then we want to build a diversified portfolio of investments, right? So when we look at assets, we have to, and most people don't know what an asset is, right? So an asset is something of value. And there are, let me just show you the broad asset classes. These are the broad assets. I'm going to go back to the other slide in a second. When we look at the broad asset classes, we say equities, real property, fixed income, cash and its equivalents, and collectibles. So what does that mean? Equities are usually things that appreciate in value, right? They have equity, they grow in value. Stocks, exchange traded funds, index funds, mutual funds, 401ks, real estate investment trusts. Those are things that fit into that category. And then we have real property, which is real estate, commodities, and precious metals. They all fit in that category. Fixed income, bonds, certificates of deposit, loans, crowdfunding, cash and its equivalents, treasury bills, commercial paper, bank accounts. Collectibles, numismatics are collectible coins, nostalgic items, NFTs. I don't know why people were buying those crazy things. Cryptocurrency, those are all collectibles. Those aren't things that will, yeah. Anyway, those are collectibles. So let me just go back. So there are different types of assets. We have equity producing assets that get capital appreciation, meaning they can gain value over time. And the only way to extract the value from them is to sell it, right? Or you can borrow against it, right? Because you're putting a lien on that asset. So for instance, if you refinance your house, you're pulling from the equity in the house and putting a lien on it. And if you don't pay it back, they'll take the house, right? Stocks, like I said, Tesla doesn't pay any dividends, but maybe it goes up in value. How can you extract the value? You have to sell the stock, or you get a margin loan and borrow against your portfolio of stocks. Then we have income producing assets, and I'm kind of skipping capital appreciation, same thing. Income producing assets pay you. So if I have a loan, that's an asset. It's a liability for the person who I lent the money to because that's a debt for them, but it's an asset to me. And it produces income. Every month they pay me interest. Every month they pay me interest. That's an income producing asset. When we look at things that produce equity and income, it can be real estate, right? So real estate, a property usually increases in value over time, but it also pays you rental income. So the best assets for what we're trying to accomplish are assets that produce both equity and income, right? Because if you have equity producing assets, you have to either borrow against it, which means now you have a liability you have to pay back, or you have to sell it and you get the cash, but you no longer have an asset. And just let me say this. There's a misunderstanding amongst people who are not wealthy that cash is more valuable than assets. And nothing can be further from the truth. Most of us have been raised to get money, get money, get money. Most of us have not been raised to get assets. And any money that you earn that's kept in the form of cash depreciates over time. What does that mean? Because of inflation, because the price of cost of goods and services goes up every year, inevitably, it never goes down. Because the price of goods and services goes up every year, that means the purchasing power of that money has decreased. You earned it with a certain amount of purchasing power. And by the end of the year, it has reduced purchasing power. And year after year after year, the purchasing power of that same money that you earn continues to decline. So you don't build wealth by having cash. So people have this misunderstanding. They say, if somebody's a millionaire, do they have $1 million in cash? No, they would be a fool to have $1 million in cash. They have $1 million net worth, which means that they have $1 million plus in assets. When they subtract their liabilities, the net worth is $1 million or more. That makes them a millionaire, not $1 million in cash. Cash is a horrible way to store value. It's a horrible way to store wealth. And so we always want to find an asset. So when we're choosing assets, and if we're again trying to make that transition to passive income, we want to find assets that also pay us income, right? As opposed to buying assets that only appreciate in value and don't pay us income, because then we still have to get earned income, and the only way to extract is to sell it. So hopefully that makes sense. And if something's not making sense, please just jump in and say, hey, can you explain that further? It doesn't make sense. All right. So we have to win the long game. We have to acknowledge that economies change, that politics affect economies, that social trends affect economies, that ideological trends affect economy, that climate change affects economies, that all these there are things that will impact the economy, meaning that every asset we own won't remain constant in terms of it producing income and or equity. So what do I mean by that? And some of it is regional. In New York City, even though the real estate market around the country has cooled because interest rates are high, which means the cost of borrowing is high, which means people can get less house for borrowed money. It cooled off, which tends to cool everything off. The rental market in New York is phenomenal, and it's regional. It's because we have more people than we have available properties. So that's basic supply and demand. Because we have more people than we have properties, there's competition for the limited amount of properties we have. It drives the prices up. So therefore, the rental market does well here. Whereas in other places where they have more inventory than they have people, say like Baltimore or Detroit, right? Both big cities, Philadelphia, right? All big cities, but they have more inventory available than they have people. So the rental market is not as strong there. Right. So if you were going to do rentals as a form of income, you have to beware of population trends. You have to beware of earned income trends in those places, because you can't charge more than what people can afford either. Right. So those things become important. So in creating your portfolio, you choose judiciously the things that make the most sense, and things that can withstand, again, these changes. So we want to have things, again, that are uncorrelated and well diversified. So let's talk about, let's go back. Let's talk about diversifying. Even in a stock portfolio, and I say this, and I tell you this, and you can do this today, most of you do not have the requisite skills to create your own well-diversified portfolio yet. And so, because there's a lot of information that you have to pay attention to that you're not accustomed to paying attention to, because you don't have to with earned income. So I am giving you this tip so that you will have a well-diversified portfolio. No, I did not lock the group. Anybody can come in if they have the password, by the way. Somebody just asked me that. No. To create a well-diversified portfolio, you should immediately, you can do it when we get off this Zoom, get an S&P 500 based index fund. Now, I don't care which brokerage you choose. There's Fidelity, there's Vanguard, there's TD Ameritrade, there's, I don't know, there's dozens and dozens. I wouldn't use something like Robinhood. I don't even think they have index fund. I wouldn't use one of the, things that kids use for apps, but a well-trusted long-term brokerage account. Open a brokerage account, costs you nothing. Look for an S&P 500 index fund. You can buy into the index fund for as little as, and I know on Fidelity, for as little as $25. And that will give you you will have ownership of the top performing 500 stocks on the stock exchange. You can't buy 500 on your own. And so this gives you a good diversification of different stocks, and it's a passive fund, so there usually are no fees. They're not trading a lot, so you're not gonna have to pay capital gains tax on it. It's such an easy way to get into the long game. And I'm not saying only put $25 in it. You got to think about how much you're going to need. And if we're talking about the last couple of years, S&P 500 has paid well over 20%. If you had $1,000 in there, you made $200 doing nothing, just sitting there. If you had $100,000 in there, you made $20,000 just sitting there. So it's hard to beat the S&P 500. So the little tip, the little trick is, again, go to a brokerage account, Fidelity, Vanguard, TD Ameritrade, one of these, and get an S&P 500 base on no fee. Make sure there's no fee, a no fee S&P 500 based index fund, and start funding it. Start funding it. That will give you a good diversification until you learn how to create your own portfolio that's much more nuanced based on what you're trying to accomplish, right? But that comes with time. Over time, you should be increasing your knowledge and your skills. Let's see. All right. So again, I'm not gonna keep you here all night. Uh-oh, my thing froze. What's happening? Uh-oh. Okay, here we go. So what I learned the hard way, and I didn't really share my story on here. What I learned the hard way is it takes a different set of skills to make money than it does to keep money. So just to share a little bit, I left my job. I was a teacher with the Department of Education. Good, decent job. I had tenure and everything. I was there 15 years. At 36, I left the job. I retired. So I'm sitting on my pension. I should just go get it, because at 55 you collect, but 62 you get the full. So I might wait till I'm 62. But I retired at age 36. Haven't had a job since. And right out the gate, I hit a home run. I had some real estate deals that allowed me to quit the job. I had 7 businesses operating at the same time. One of them was the #1 hostel in New York. I was making so much money, it was ridiculous. And I mistakenly attributed it to my own genius, not understanding that I just happened to catch the economic cycle in the right place and meet the right people. And none of us really knew what we were doing, but we took advantage of the system and we were making money hand over fist. And in 2008, so I left my job in 2004. So for 4 years, I probably made more money than I had by far in the whole 15 years that I had been working on my job. In 4 years, more money than I had in 15 years. And I thought I had the Midas touch. And then those of you who remember, in 2008, if you're old enough, we went through a recession and the whole economy just went down. It was the worst economic downfall since the Great Depression. And I didn't understand diversification. I didn't understand being uncorrelated. I didn't understand being over leveraged with debt. I didn't understand any of those things. And so I was fragile. So when that thing went down, everything I had went down. And, some people tell me, oh, I'm in debt. I'm like, well, how much in debt are you? And they tell me, oh, I'm $5,000 in debt, or I'm 10,000, or I'm $20,000 in debt. And I kind of chuckled because I was well over a million. I was a couple of $1 million in debt at that point, because I didn't understand that it's a different skill to make money than it is to be able to keep money. So long story short, I was able to overcome all that and bounce back smartly and make myself anti-fragile. So I will never be in that situation again, because I understand now what it takes to protect those things and what it takes to make those things make money in any economy. So, how do we protect ourselves? There's certain things you need to do first to protect yourself as the number one asset, because you're the number one asset. So there are certain health docs that you should have, healthcare proxy. If you need to make your wishes known to somebody you trust who can speak on your behalf if you're incapacitated, that's important. If you choose to have a DNR, you need to make sure that is known, because if you don't want somebody cracking your ribs and you come back and you're not where you want to be, then you need to have that. If you want to be an organ donor, you need to make sure that is known. So there's certain health docs that you should have in place if you don't have it in place, and you can't wait until you're incapacitated to do the document. So you need to do it now. You should have health insurance. Everybody is entitled to health insurance in America now using the Affordable Care Act, and get it now because it's on the chopping block. But if you're in New York, I think it's New York State of Health. You can go there. If you're in other places, they have their own, but it's under the Affordable Care Act if you don't have it with your job or some other way. Everybody should have life insurance. So let me just talk about life insurance for a second, because people blow this every time. There are all these fancy life insurance policies out there: universal index life, whole life, blah, blah, blah. They got all these fancy names for all these things. And the way they sell it to you is based on your own belief that you have lack of access to this other world we're talking about. And so they say it's a way for you to gain cash value. It's a means for you to borrow against. And that is not what life insurance is for. Life insurance is simply a death benefit. It is not an inheritance. It is not a credit union for you. It is not an investment. It is a death benefit. And the amount that you need is determined by where you're at in your life, right? And so my kids are all young adults, unmarried. They don't need a big life insurance policy. They need enough to be buried. That's it, right? They don't need some fancy stuff. So term life insurance, if you don't have it and you're older, it's going to be hard to get term life insurance. But if you are not elderly and or already sick, term life insurance is all you need. And then how much coverage do you need? Again, depends on your life situation. So if it's just you, you need enough to bury you. That's it. If it's you and you are the primary breadwinner or a major contributor in terms of breadwinner to your family, then maybe you need a couple of years until they can get on their feet of the amount that you contribute after taxes, right? So if you make $100,000 salary, you don't really contribute 100,000, probably half of that. And if you do 3 years of that, then maybe you need $150,000 worth of coverage. Some of it depends on how young your kids are. Some of it might depend on, different factors, but you factor that, and that's the amount of coverage you need. Why term? Term usually has a term of 30 years at a fixed price, which is way lower than all those other types of insurance. At the end of the term, after 30 years, your children are usually grown. You should have accumulated plenty of assets. You should have transitioned to these other types of income where you don't have to rely on survival from a death benefit. And so at the end of the term, you can reduce the payout, which will reduce your premium because you don't need as large of a payout. So everybody should have life insurance, but the minimal amount that you need in order to cover the things that are important in your life at this moment. You can consider disability insurance if you, again, are a primary breadwinner. That could be important because you don't want to be a liability to the family should you get disabled, which is more likely to happen than early death. Um, Make sure you insure all valued assets from loss and or liability. So what am I talking about? Homeowners insurance. You should have homeowners insurance because if you have a fire or some kind of disaster or somebody gets hurt at your place, you want to make sure you have liability insurance. In New York, you must have auto insurance if you drive, so that's a must. But there are other assets that you might own that you fear losing, right? So if you have a business, again, business insurance. If you have I don't know, some collectible that's super valuable, you should have it insured. So make sure you insure all valued assets. You also want to create the proper legal structures to shield you from personal liability. So if you have rental properties, you should transfer the deed out of your personal name into maybe an LLC, a limited liability company. Why would you do that? Okay, so let me give you an example. Recently, we've seen a lot of airplanes crash for some weird, bizarre reason. We've seen these airplanes come down. And unfortunately, we've seen people die in pretty much each of these airline crashes. Every airline puts each separate plane in a separate LLC. And why is that? Because I think we had 67 maybe deaths or 87, something like that, deaths in one of the, you're going to have that many lawsuits for millions of dollars, which could possibly, after the insurance covers what it covers, it could possibly bankrupt a company. But if that plane is in the LLC, you can only sue that LLC. You can only sue for the value of that LLC. So there's no value. You might get a judgment, but that plane burned on the ground, so it has no assets. And whatever insurance doesn't cover, there's nobody to go after. And you want to do the same thing with your rental properties. You don't want everything attached to you because after getting the value of whatever that property is and whatever the insurance pays, if it's not enough, they come after your personal assets. You want to protect your personal assets from liability. So your LLC owns that. LLC is a flow through, so you still get the money, but the LLC is the barrier between you and problems. So, and that's the same thing if you create a brick and mortar business or an online business, you want to have the proper structure to protect yourself from liability. You should never be a sole proprietor. You should never be a general partner. Corporation, whether it's C Corp or S Corp, LLC, or the structures that will protect you from liability. And finally, you want to develop an estate plan. Death is inevitable. It's going to happen. We don't get to choose when, where, and how, but we know it's going to happen. So if you don't have a legal plan in place to transfer your accumulated wealth, the state will decide how it's distributed amongst the surviving family. And you might not want that person to have had anything. So you want to create the best strategy for you to transfer your assets without the assets losing value, and you want it to be seamless, and you don't want it to be contested by somebody who you didn't want to have it. And that doesn't mean that necessarily a person. It could be a cause that you believe in, right? So you might say, I don't have any heirs, but you might believe in a cause, and you want the cause to benefit from what you have. So everybody should have a will. If you don't have a will, shoot me an email and I'll send you a template so that you can just fill in the blanks and get it notarized. You have to get it witnessed by in New York, 2 people, and have it notarized, and you have a will. Everybody should have a will. If you do not, I promise you, somebody will be fighting over your stuff. And that's a terrible thing to happen. Relationships get destroyed. It's all kind of stuff happens. People always swear it won't happen to their family, but it does. It happens to every family when there's ambiguity and emotions are involved. You could create a trust, right? So a trust allows for a seamless transfer of assets to a beneficiary. The thing is, if you do a trust and you put stuff in a trust now, it doesn't belong to you, it belongs to the trust, and there are different rules that govern that. But a trust allows kind of secretly for assets to be transferred to a beneficiary. So that's something you might want to consider if you really want somebody to have something, you don't want it to be public information. Make sure that on all of your accounts, so when you do your brokerage account, you do your bank account, when you do all your investments, there's a place for a beneficiary. Make sure you fill out the beneficiary information. Who do you want to have these things? And more important, if something in your life changes, if you get divorced or you get estranged from a family member, make sure you change the beneficiary information. Because the worst thing you want is to, and I've seen it, people who get divorced, they pass away, and the ex gets all this stuff because they never changed the beneficiary information. So make sure you update as needed. This is important too for whoever you expect to be the executor or executrix of your estate. Make sure you leave a complete list of assets and your financial accounts, including the value of them, where they can find them, especially if you have collectibles hidden. Some of you hide them in weird places. Make sure they know these hiding places. Make sure you have account numbers, passwords, the security questions, all that stuff is important. It has to be somewhere that they can find that information. So that's important. So I don't know if you guys have any questions. I'm gonna kind of wrap up in a second. No questions so far? So far, so good? Okay, good. All right. So I know that was a lot in a short amount of time, and I gave you the what to do, but the details of the how to do it are very nuanced and take a lot more time than I can give you, tonight. But if I were to give you an opportunity to learn all the skills that you need to be able to create sustainably these multiple streams of income to acquire equity and income producing assets, the question is, would you take advantage of it? Or are you comfortable just trying this on your own? If I gave you the opportunity to create that lifestyle, to even help you design that lifestyle, and gave you the tools to take immediate action, would you do it? So I do have a brand new course that I'm offering on Wednesday nights from 7 to 9. It's going to start in 2 weeks, where you will create a personalized, bulletproof income and asset acquiring system that supports the lifestyle of your dreams. You'll develop the skills that you need. I'll teach you how to fund it. I'll teach you how to capitalize on important trends. We didn't really get into the different economic cycles and trends tonight because we didn't have time, but how to make sure you profit from every cycle. There are signs that we're moving to different cycles. How do you recognize the signs and prepare for it ahead of time? How do you profit from it? How do you know when to switch? All that's important. I'll show you how to protect and preserve everything that you create so that, again, you don't have to worry about building this thing and losing it. I'll show you, and we didn't talk about tonight, how to legally use the tax code to your benefit. And we didn't talk about it, but the passive income streams, you pay far less taxes. As a matter of fact, on unrealized gains, you pay no taxes. So you can have your assets building value, and you don't have to pay a dime on them because they call it unrealized gains. And that's how the rich get around paying taxes. Whereas, again, the earned income, you will always pay taxes on your earned income. So I'll show you how to use the tax code properly to minimize your tax obligation. And I'll show you the best ways to protect and pass on everything that you can create. So like I said, we're going to do 6 live stream interactive skills sessions where we go through the different skills and create your blueprint. Again, we're going to meet starting the 26th, so not next Wednesday, the following Wednesday, so you can get your schedule in order. It'll be 6 consecutive Wednesdays from 7 to 9. You'll get the links to the video replays so that you can keep going over it, because sometimes it's hard to get it while we're sitting there. You'll also get the slides in the PDF format so that you can look at the slides also. There will be a workbook that has important links like debt calculators and, interest calculators, and you have all these things and these different apps that will support, and AI tools, which is important now, and different AI tools that will help you to not only put this together, but organize it and manage it so that you can grow a lot easier. There will be weekly action steps. So to keep you on track, like this, what you should be doing, this is what you should be doing to keep you on track. We will do 2 post-course support sessions. We'll do one a month later and then another one 3 months later to make sure you're still on track. And you got to ask yourself, okay, if I can change my life and get the lifestyle I want, how much is it worth to you? Not how much would you pay, but how much is that worth to you? And I've seen people who charge $25,000 for it. And I think that's just outrageous because I think if you had $25,000 and people rob their retirement plans to pay it, I think that's insane. I think asking 5,000 is insane. 2,500 is insane. But let's talk about the number 1,500 and talk about this. If there's a 100% money back guarantee, which means there's total risk reversal, that if you're not happy for any reason, you can take it and run, and you just don't want to pay me. And you say within a year, I'll give you 100% money back guarantee for a full year. Full year, you say, man, I tried it, don't like it, give me my money back. I give you every penny back, not a problem for me. So 1,500, 100% money back guarantee. But I'm also going to throw in some bonuses. So some of you know I wrote a book called Recession Driven Riches, which is to me a great book. I would say so myself, right? But I'm absolutely going to throw the book in. But I also did quite a bit of courses over the time. So I did a course on obliterating debt, right? So even though we're going to cover debt, I'm going to give you a full course that I did just on obliterating debt. Because if that's your thing, you might need every detail. That comes with not only videos, but also a workbook for that. I'm going to give you my ebook. That used to be my number one selling product, Insider Secrets to Near Perfect Credit, so that you can actually, if you have credit that's not so good, all the things that you need to do to build your credit and make it great. I'm going to give you my course, Insider Secrets to Stock Investing, so that not only will you be able to do the index fund, you'll learn all the different things that you need to know to build a portfolio. I'm going to give you my Insider Secrets to Real Estate Investing course, which gives you dozens of ways to invest in real estate, whether it's through REITs or all the way to commercial properties, however you want to do it. I'm going to give you my Insider Secrets to Entrepreneurial Success video course that teaches you how to go from just having an idea to building a business completely. And I'm going to throw in 3 one-on-one consultations on top of that. So after the course, that means, yeah, we have the follow-ups as a group, but just for you, just for your personal, we're gonna do a Zoom consultation and we'll work on whatever specific things that are for you that you need. So when you look at that, that's $1,500 worth of bonuses and a $1,500 cost. That's a $3,000 value. But of course, I'm going to make it sweeter. I love using people's success story. I love it when people say, you got a success story? And I'm just pull one out. If you allow me to use your success story, right? If you check a box that when you're successful, I can use your success story, I'll take $300 off the top. So on a registration form, just check that box and you're talking about $1,200. So for $1,200, you get the course, the follow-ups, the one-on-ones, the video courses, the book. You get all of that. And if you don't have $1,200 up front, you can split that into monthly installments, 12 monthly installments at $100 a month. $100 a month, you can't beat that. Some of you blow that on silly things. So for $100 a month, you can change your life. So I think I can put this in the chat. Right. This is a registration form. If the one we just talked about is the gold option, there are other options. There's a budget option where you just get the course and nothing else. And then there's a premium option where you get extra one-on-ones, but choose the one that makes sense for you. And again, we start in 2 weeks. I think I can put this in. I think I can put this in the chat thing. Let's see.